In the past few months, shares of Apple, Nasdaq AAPL, the world's most valuable tech giant, have soared, although we experienced a bear market earlier this year, but the current share price has surged 35% from its June low, since Apple's market cap is as high as $2.8 trillion. Therefore, its rise and fall will have a huge impact on the S&P 500. The biggest question facing Apple investors right now is, in the current market environment, can the stock's rally continue? On the one hand, we have noticed, in the company's latest financial report, Apple's revenue and profit were slightly above analysts' expectations. iPhone sales are also better than expected. That is to say, it seems that the market still has high demand for Apple products. Market expectations are also rising. On the other hand, it is undeniable that in the short term some risk factors still heading to Apple's rally. US economy still struggling, inflation remains at 40-year high, and interest rates continue to rise. These headwinds may damage the market demand for Apple's products and services. And earlier this year, the company has also warned the third quarter could be tough because the supply chain is blocked. Sales could fall by $4 to $8 billion. At the same time, Apple suppliers have also shown signs of slowing demand. In Micron Technology, MU warned last week that sales for the quarter will be lower than expected less than 6 weeks ago, and earlier Qualcomm, INTC and NVIDIA also all disappoint revenue expectations. In addition to these risk factors, Apple's stock price after this rally also looks more expensive. The share price is currently trading at around 27 times its expected profit over the next 12 months. The average price-to-earnings ratio over the past 10 years is 17 times. If the market fluctuates again in the short term, then Apple's valuation bubble will undoubtedly be greatly squeezed. According to the valuation model, Apple's current fair value is $154. This means that the stock has a potential decline of 11.3% in the market outlook. Anyway, we still think Apple stock is a long-term benchmark for investors. Every drop, it's time to enter. Morgan Stanley predicted in a recent note to clients, Apple's stock price could soon top $200. Market cap hits $3 trillion mark, the investment bank said. Although Apple has adopted the lifetime value business model, but for the market it's still a hardware company. The so-called lifetime value, Chinese translation is customer lifetime value, also known as customer lifetime value, CLTV/CLV. Aims to build so-called lifelong relationships. It's like building a relationship as a husband and wife or as a friend, calculated according to Morgan Stanley's model. In this mode, Apple users will spend $2 a day on their products or services. That number has now been achieved among US iPhone users. In the long term, another advantage for Apple is its safe haven attributes, and during a possible recession, ability to return large amounts of cash. Apple has about $200 billion in cash. Share buyback program can be ramped up quickly when needed, thereby propping up its stock during difficult times. Overall, taking into account macroeconomic headwinds and demand uncertainty, Apple's sharp rise over the past 2 months has seen its valuation soar. Having said that, for long-term investors looking to hold large defensive stocks to weather a potential recession, Apple is still a great option, and the next time the stock fell might be the right time for the layout.